Ready to maximize your 401k returns as a US NRI? Join our upcoming webinar to take control of your 401k account and achieving your goals.
But still, in between, there will be a phase when market will start thinking that Patanjali will rock Colgate's port. And at that time, you will get Colgate to buy. And you have to buy then. You can't say that market is in a sideward phase. I won't buy any stock now. I'll buy only when the market starts going up. So, even in these companies, there will be a phase, like you mentioned Siemens while we record. Siemens is in a very, very bad position in Germany because it tried to develop a 5th generation wind turbine and it flopped. So, the company has run out of capital and it has gone to the German government to seek support. So, this is a time when Siemens will be weak. If there is some ripple effect on the Indian subsidiary also, we don't know, then probably you may, if you are lucky, get that stock in an opportune valuation or at an opportune valuation. So, these are the things that you look for and not for whether the overall market sentiment suits aggressive investment.
Actually, over 40 years plus of investing, I've learned one thing: never look at the market, look at your portfolio. 2002 to 2007, your portfolio would have done nothing if it had pharma and FMCG.
Correct.
So people call it a market boom. I say it was an infrastructure boom.
Correct.
You had shares like BHEL at 300 plus, which was available in 2020 at 25 rupees. Right. That is the kind of crash one has seen in a Wipro or a BHEL or even in Cholamandalam and Kotak, and all of them just went up dramatically. Tata Power, they all went up dramatically in that phase and then came down and stayed there. So there I agree with Prashant Jain. He says there is nothing called a market boom, it is sector boom. So you have to look at how your portfolio is doing rather than worry, oh, market has got 65,000 or 68,000. Doesn't really matter. As your portfolio, how has it done? That's more important.
Essentially, people use top-down sentiment for doing their investment allocation. Whereas it is the bottom-up performance that generates all the beta and alpha. So, top-down will only give you 10-12% because that's what the index gives you. If you're looking at the economy and the index and the country and all that, then you can't aim for more than 12%. If you want to make more than 12%, you have to be bottom-up and you have to be invested. And you must make sure that when there are lumpy returns, you are not caught outside the asset class. You are not got out of equities, you are not got underinvested in equities, and you are invested in the right place, because you could have been invested between 2002 and 2009 in pharma and FMCG and completely missed buying either small caps or infra or businesses which benefited from that, right? So you should have bought a few things which are good capital allocators. I am not saying you should go and buy Anil Ambani group, but you could have bought Siemens, you could have bought a ABB.
Yeah, even a BHEL. And you could have sold a BHEL at 300.
You could have bought several other companies. What I mean to say, there are other alternative ways where you could have efficiently and effectively played the boom without buying the companies you don't like. So there is always a set of companies which you can buy in every market context. So in the present context, we have had massive lumpiness of returns between 2021 and 2023. Today people expect this lumpiness to sustain. They expect to make more returns on this wave. What are your thoughts on that? Do you think it's feasible?
It may be feasible, but in a completely different set of companies.
Okay.
You know, so sometimes it will happen that the market cap of Sun Pharma is greater than, say, all banks, or something like that happens. Then you know that one sector is terribly overpriced in the market. You may be leaving the market early, right? You may be leaving the party early. You may be leaving the party at 11:40 or 11:30, and you know at 12 when the clock strikes, all your horses will turn to mice, right? You have to have the ability to look like an idiot from 11:30 to 12 when the clock strikes. That is one skill you have to develop, and that happens when you're just managing your own money and not answerable to people. But even when you're answerable to people, you have to tell people, boss, please believe my conviction. This is what I do. And that is where your good fund managers who are willing to look like an idiot in the short run and look like a genius in the long run. This has happened to Prashant Jain, this has happened to Naren, it has happened to everybody.
So you're saying in this market also look for lumpiness of returns where the market is not expecting performance at all. So invest now to see that. This happened to me in 2018 because I was selling one set of companies and I was buying capital goods companies in 2017, 2018. So I was buying from 2018, 2017, again 2019, 20, a lot of capital good companies. They were still slightly expensive optically, in the sense they look 25 times or 30 times, but they are not getting that growth yet. The moment they started getting growth, the PE dropped to low double digit. And the market had to reprice the company. So suddenly you find the company which time corrects for 2-3 years, triples in 1 year. Or a company doubles, stays there for some time, and then from there again triples. So these kind of things happen. But the trouble is when you come off a high base like now, you have to be very careful in your choices and very calibrated in your buying. So that is where these sideward markets, where there are not many opportunities, valuations seem to be slightly elevated, give you specific chances to buy companies. They don't give you a secular chance to buy companies. So when I see even my friends or clients who saying, is this the right time, is this the right time? I feel that they are not looking at their portfolio at all. They are just looking at outside world, what people are talking, what CNBC is telling. In your portfolio, if you are buying a company which has got a very good runway into 2-3 years, then you should focus on that. You should focus on what Mr. Market is telling. And you should ensure that you invest money regularly, maybe every month, every quarter, which seeks these opportunities which the market is not seeking. This is what I have done, and from what you are saying, more or less what your entire experience has been, which is be very bottom up, be very company specific, and when you are not getting lumpy returns or when you don't see lumpy returns, look to build larger positions so that when the lumpy returns come, a big position makes big returns. Because otherwise, you are never going to build your positions big enough and it will all look like a long tail portfolio. Has your portfolio ever looked like a long tail portfolio where you felt I could have bought more, things like that? Or do you believe in concentration?
I don't believe in concentration, but you know, every portfolio gets concentrated because some of your shares have done very well. So you may have had a small position or what you thought was a small position, but a split and a bonus and a split and a bonus just takes the number of shares high, the market gives a higher PE and suddenly your portfolio gets to be very heavy on the head and have a long tail. Then the question is, do you have the willingness to sell the big positions? Or do you wonder whether to get rid of the small position? This dilemma is always there. No, I look at the big ones and say, okay, let me sell a little bit. Whenever I get an idea to buy something, like if I want to buy a small share today, I sell some of my big ones and fund it. Yeah, rather than bring up from outside money. I will never be able to sell the whole thing. I've always said that my love for that company is so much. The people say you should not fall in love. It is impossible. If I've fallen in love with a company in 1986, I can never ever come to zero in that share, right? So I can't come. So I don't do that. Also, there is always the worry that if somebody tells you that this share will be worth so much after 20 years, 30 years, your ability to imagine is not there. Sometimes you can imagine, but rarely. I mean, look at it this way. If the country grows at 9% for the next 5 years, and you think there's some small NBFC which will grow, how will this growth be missed by SBI, HDFC and ICICI? They can't miss this growth, right? Most of the rain will happen in these banks. The smaller ones will benefit, no doubt. Maybe proportionately they will go higher. But will you have the guts to put all your money in that? I will not. I will not sell my HDFC bank to put into the next HDFC bank. I've seen at least 20 next HDFC banks. But HDFC bank is HDFC bank.
The next HDFC bank is HDFC bank.
Perhaps, maybe there is something else, but I'm blurred by the fact that I invested in HDFC Bank in 1994 and never cut my position for very long periods of time.
You are saying that this lumpiness may or may not extend. If it extends, it will be in new sectors, new companies. So, what should a long-term investor focus upon now? Should he look at new sectors or should he go back to buying the same companies he likes? When do you do that? I want you to tell me when you go back to your old companies to buy them. Is it in a market point like this or in a different market context?
No, it will be in any point in time. If somebody tells me, oh, the fertilizer industry is going to do well and I have the best fertilizer company, then I look at all others and say, let me buy more of my own company. I don't need to add a new company just because that industry is doing well, because the industry leader will anyway do well. So if Indians prosper, a Maruti with 55% market share will definitely benefit, right? If more Indians travel, it will be Indigo with a 60% market share which will benefit. So some of these leaders will benefit. You don't have to worry too much. But if a new airline gets listed and which is saying only business class seats, etc., maybe a small stake there, but the big beneficiary will be if more number of airports come up. Who will fly to those places? The guy with 60% market share. Right? So he will anyway benefit. So if it's already there in your portfolio, don't make any change. Also, like what Phil Fisher says, I'm afraid that at my age of 70, I want to be in index funds because I don't know whether my mind will be able to make those complicated decisions which are necessary. So I may go into a simplified portfolio. Also, if my wife and daughter don't want to manage these complexities, I may go into simple portfolios. So at those stages, which is my situation, nothing to do with the market or returns, etc., I may go to a simpler portfolio. But otherwise, I don't see the reason to change much in my portfolio style.
Any specific advice you have for investors who have made lumpy returns in this market? We made unbelievable money. Any advice for them?
Yes, what I would do for such things is, suppose you're 45, 50 years of age and you know you're going to retire in another 10 years, take some big solid money and buy yourself very good returns, maybe an annuity, maybe, some multi-asset from which you can withdraw after 10 years and put it there. You are not improving returns, but you're reducing risk. You're taking money from equity and putting in a fund where 35% is equity, remaining is debt, gold, foreign equity, etc., and multi-asset. Some money in BAF, which is balance advantage fund. So you're putting some money in equity, some in debt, and getting all better taxation than just what debt is getting. And if you have enough money there for your next 10-15 years expenses after retirement, after that it hardly matters how much you have in equity and how much you have in debt. You've already solidified your returns, then it doesn't matter, and you can play around with your equity, buying big mid cap, small cap. Again, I don't believe in this mid cap, small cap because I simply believe if the large cap Maruti is doing well, his supplier who's a mid cap will do well, and his supplier who's a small cap will all do well. So I would rather look at an industry rather than cap. But unfortunately, when data is available, people draw lines and parallels and say, this is the turn for large cap to do well, this is the turn for mid cap to do well. I don't believe in that. In my whole portfolio, I've never believed in that.
That makes for very interesting conclusions that be very bottom up. You don't have to worry about sectoral divides. You must be very opportunity specific. Look for new opportunities only if you really like something. For the sake of adding opportunities, you don't have to add new ideas, you don't have to pursue anything new, and make sure that you have the patience to wait with an opportunity till the lumpy returns show up at your door. When the lumpy returns show up at your door, don't rush, take them at your own pace and don't do total exits if you think a company can be held for much longer periods of time. That's broadly the sense that I get from this conversation. Thank you very much, Subra, for this wonderful conversation, and let's continue in another new conversation.